Welcome to the video. In this one, I'm going to be talking through a very simple strategy for trading ranges. So I'm going to use Euro USD in this instance. The time frames we're going to use to trade it are going to be the 1 hour and then either the 5 or the 1 minute. It's up to you. I'll talk through some different aspects of that depending on your style of trading. But the key here and the key takeaway is to see just how simple trading can be if you don't overcomplicate your technicals and you just focus on price action and structure. And even support and resistance can be used. So we'll jump straight in. The first things first, though, when you're identifying your range, you want to use a higher time frame. In the strategy, we're going to use the 1 hour, and we're going to want to see 2 taps on an upside and 2 taps on a bottom. That is going to show us that we have price ranging in this instance. And as you can see here in this example, 1 tap here, 1 tap here. So we've got 2 taps at the top. I'm going to mark that with a zone. And the reason we're going to use a zone rather than a line is that a zone is going to give us more flexibility for where we can enter without seeming, it just is visually easier to judge where price is going and allow it to see price move rather than having a single line. And then to the downside, as you can see, already 1, 2 taps down. So what we see here is that price is in a sideways range. I've drawn my zones from the candle closes of the highest level, which is here, it's higher than here, to the longest wicks. As you can see, price has tapped it here still too, so that is our 2 touches. The same thing here, lowest candle closes to the lowest wick. This low touches too, so therefore we have a nice clean range. Now, how do we trade them? Because it's all well and good spotting a range, but how do we trade them? So first things first, we want to wait for price to come to the range. You can use alerts for this. And then we want to see one 1 hour candle, not break the range basically. And as you can see here, price wicks it, closes above, but it didn't break the range. So we're all good. So now that we've seen that, we can switch down to the lower time frames. And there are a couple of things you can do here for entry, depending on how you like to trade. So the simplest version is going to be to go to the 5 minute, see that we've had our touch, and now wait for price to touch the range again and give us a nice clean entry trigger like a bullish engulfing candle. Not this one, because this was part of the initial touch. And what we see is price pushes down into the range again. And what do we get? A super clean bullish engulfing candle. It pushed to the bottom. We had nice wicks, if I move this up so everyone can see. We had nice wicks wicking the bottom of the range again. We had the 1 hour candle before validating that price is still respecting that range low in some way because it didn't close and break it. And now we've had a nice strong engulfing candle from the bottom. And this is how simple trading can be. You literally have your level, you have validation of the level, and then you have an entry using a single candle pattern on a lower time frame. That's it. As you can see, it's 5.7 pips to low. We're going to add 2 pips on and round it up because I like whole number. Stop losses, I don't like stop losses like 2.7 or 7.7, or round it up to 8. That's what we've got. And then as with range trading, you can aim for the high of the range. Now, you're not going to want to leave all your profit on the table here. There are various systems you can do. You can take some profit along the way. You can move stop losses to break even. That will depend on your personal style. Some people like to just hold trades the whole way. Again, up to you. But the best thing you can do here is to very much test that and see what works for you in terms of what raw statistics give. And as you can see here, price pushes up, it comes back, as you can see, and then continues up again. Now, I'm going to go back a little bit because I don't want to spoil the next trade, but that is an incredibly simple trading model. Literally, all we had is price action, knowledge of how to spot structural highs, because we can see 1 and 2 there and 1 and 2 there, and then price action for entry. It is painfully simple. Now, if you are someone who likes to use what I would class as maybe a little bit more complicated entry models, you like to enter on the 1 minute, you like to look for liquidity, things like that, you can do that too from these range. Your entry would just be slightly different. But I wanted to do this to show you just how simple it can be and how you don't need to overcomplicate. However, if you do want to use different models, other than just price action and candles, you look for things like liquidity, as I just said, where, on this time frame, nothing jumps out to me. But if we look at the 1 minute, for example, we go down, we already had our validation of the level up here, price then pushed down. And what do we see? So first things first, we had price start to change or give its first indication of changing to bullish structure on the 1 minute here, where price broke this high to the upside. Now, you wouldn't want to enter based on just that, based on the fact that price has pushed down hard, and this is an internal structure. If we draw the structure on, which I can do to make it easier, I always forget where the brush is. You can see price comes down, up, down, and then this is internal because we've still got this high here. And with it being internal and with the fact that it's just quite a weak break, I wouldn't want to be taking buys yet. However, what we then see is price start to come back down. And what do we see? The most clear wicking sweeping candle of this low that you're going to see before a very strong push to the upside. And then in that case, that's when you might look to go long if you're looking for some sort of liquidity sweep first on the 1 minute, and you're looking, liquidity traders, some will trade pullbacks here, some will just trade on the breakout here. But as you'll notice, the trade is near enough the exact same anyway. So again, what I really want to get a point across with this video is that no matter your style, all concepts are very closely interlinked. It doesn't matter what you use as long as it's something that works for you. And if you do want to go as simple as just trading ranges with support and resistance and price action, you can. But that's that example done. What you'll notice now is price has come to the top of the range again. And that was a very, very clean push. And now it's come back up. What do we need to see? First things first is a 1 hour candle not breaking the range to show that it is still solidifying that range in some way and that range high in some way, which has happened because we've got this 1 hour candle here. It's closed below the range. It's given a wick. It hasn't broken the range to the upside. So as soon as we see this, and this closes at 11 o'clock, so it opens at 10. After 11 o'clock, we can begin to look for an entry. So we'll start off with the simple price action candle patterns first. Let's get ahead to 11 o'clock, which is here. Now, all we want to do is see price come into the range again, or say the range high again, this zone, and give us a bearish engulfing candle on the 5 minute. That is, again, the simplest form of entry we can have. And let's see if we get that. We do. Really, really clean here. Very nice engulfing candle. The body, and again, this is important. The body of this candle engulfs the body of the first, so nice engulfing candle. Nice wick to the upside too, which is just more of a aesthetic choice, but we enter on the candle close. Stop loss is 8 pips again, because if I had 2, it's 7.3, round it up to 8. And again, we'll target the lower range zone. So very simple trade, and what happens? Price shoots to the downside. Now, again, stupidly simple. All you did here was mark a range with a simple rule of waiting for 2 taps to a top and a bottom in a sideways area on the 1 hour. We waited for the 1 hour candle to show us that the range boundary was valid, which it did. Then we looked for a nice entry trigger that gave us a nice risk reward. That's it. And this is a good example of why I use zones, not lines as well, because the line would be at the bottom of this zone. But as we can see, this is within the zone, the entry. So is this one. So it just gives us that bit of extra flexibility when looking for entry, gives us an area rather than a really specific line, because the markets are imperfect, so trying to be too precise can at times be a hindrance in trading. Whereas if you just follow a very simple model that is backed by data in a general area, and this is still quite precise, right? This is what a 4.5 to 5 pip area. It's still precise. Nice trade. As I said though, you may want to trade not with just simple price action. You might want to look for liquidity, things like that. And what do we see? Again, the 1 minute's kind of the most common for liquidity. And what do we see? We've been waiting after we saw from 11. So 11 o'clock's over here. That's when that first 1 hour candle formed. Price then pushes back up into the zone. And it's in bullish structure here until, what do we see? This previous high that was formed by the 1 hour gets swept on the 1 hour, on the 1 minute, sorry, before price very powerfully. As you can see with these consecutive strong candles, break structure to the downside. So you've had your sweep, you then get a break of structure in line, breaking this low here, as you can see with this push down, and then your entry for a 1 minute liquidity model would be, again, dependent on how you trade. It could be over here in these highs here, it could be on the break, who knows, it depends on your strategy. But again, it's just illustrating that the entries are very, very similar. all you've used is a liquidity model on a 1 minute compared to a simple price action model on the 5 minute, which also did provide this nice wick in the first place. It's the same outcome because generally speaking, most strategies are very, very similar. They're based on the same things: supply and demand, support and resistance, liquidity areas, order blocks. They're all in the same general vicinity all the time. It's just a slightly different way of using them, right? If we're looking at support and resistance on the 1 hour, if we're being really specific, we might draw it with this line here. But if we're being a bit more general with the zone in just terms of looking at these wicks as an area of resistance, then we can use the zone itself. And if we carry on now as well, I want to talk about how we can see that this would be invalid. Is price comes down again to the range low, forms a wick again, validifying that zone. So then if we move down to the 5 minute, do we get a price action entry? Price moves back down to the zone and gives another engulfing. The thing I would say about with this one is if you're generally looking at a risk reward of say 3.8 and 4.1, so generally 3 to 4 or 3 to 4.5, are you necessarily going to want to take this trade, which has happened like this, gives a 15 pip stop loss, and then only a 1.42 risk reward? Maybe you do. Me personally, if my strategy was saying that I normally aim for 3 to 4 or something in that area, if it's less than half, probably not going to be taking the trade. If we switch to the 1 minute, then in that instance, for me, nothing jumps out as something clear when we're talking about the liquidity. Maybe where price sweeps down of these lows here and pushes up strong, but it doesn't sweep any of these lows over here massively, not with this wick. So for me, probably not. But again, if that was, and you did take that, and this ended up, as we'll see, pushing up for a bit, but then ended up pushing to the downside, then, you'd be left with what, 10 minus, I'll say 10, sorry, 9% minus this one. So you'd still be left with 8% if you had taken that. So very, very simple though. And in this video, if you take anything away from it, I hope it shows you how simple you can keep your trading and still be profitable and still get excellent trades and excellent movers. So last thing with this strategy in terms of 1 hour ranges, you're not going to see them all the time. They don't form constantly, as I say, if I say that to show it as well. If we zoom out a bit, you can see there aren't really any other 1 hour ranges in the whole last half of this month, except for this one, meaning that except for if we're looking at the really bigger ones, up here-ish, that doesn't really fit, to down here-ish where we've got a clear level. I guess you could call it this one at the start, and then over here. But you'll notice it doesn't happen so often. So the key takeaway from that is that you'd want to trade multiple pairs. You wouldn't want to just be focusing on 1 or 2 pairs. You'd realistically want 10 plus if you're trading this kind of model. But again, completely up to you. So I hope this has been useful, and I hope you take away that it is very simple and it's possible to trade very simply, and that no matter what your strategy, it's very close to other strategies anyway. I hope it's been useful. Drop a like, subscribe if you have found it useful. I'll catch you in the next video.